Joining us now, Brandywine Global Portfolio Manager Jack McIntyre, Fed Up author Danielle DiMartino Booth, and our very own Susan Lee. Danielle, I want to start with you. This concern over the yield curve. In real time, help us understand what is actually happening, what investors are doing that is driving this flattening of the yield curve, because a lot of economists and the Fed would seem to be a little bit concerned about this. In the past, it signaled recession. What are we being told and what's happening?
Well, I think that some of it has to do with mechanics at this point. And right now, the Treasury is issuing a ton of short-dated paper. So it's a simple supply-demand situation in part. And that's why I think Fed policymakers in these minutes stated that there were several factors that were leading to the flattening that we're seeing in the yield curve. Again, we have to finance a lot of these fiscal incentives that have come out of the Trump administration. It's not free. And as a result, we're selling a lot of short maturity paper. So
I can get out of 2-year and go into even shorter where I'm going to get a better bang for my buck.
You can get 90-day paper. You can get 60-day paper that actually pays you something. So investors have continued to crowd into the shortest end of the yield curve as well. And then there's a flight to safety based on people's concerns at the other end. And that's what's dragging down the benchmark 10-year, which Nicole just said was at 1.84%.
So, Jack, let me ask you, wouldn't that, if I were the unwise investor and I'm not the brightest investor out there, I would be thinking I got to be in equities, but I'm watching, we're really off the session highs now. We're only up, and I always say only, up 132 points. But wouldn't the smart money be going into equities right now?
Well, I'm hesitant to say we need to pile into equities. I mean, they've had a decent run of late. I like a little bit of a barbell approach. I'd own some long-dated treasuries, and I'd own some risk assets. I would own some equities as well. But you need that treasury only in case the Fed tightens a little too aggressively in here. But I like it. On first blush, it sounds like they're covering all the bases in terms of some of the risk factors that they need to be aware of.
But some of that risk, Jack, has to do with the concern about going forward with the potential trade war with China and then our other trading partners, right? That's the big factor.
Yeah. That's a huge factor because there's a tremendous amount of uncertainty around that. And that's part of why the long end of the curve has been outperforming, because we just don't know where this is going to go. Hopefully, calmer heads will prevail, but that's unknown.
So speaking of calmer heads, Susan Lee is standing by to help calm us all down. Because, look, you spent 10 years. You were in Asia for 10 years.
Yeah.
And this is the headline. This is what we're going to be talking about this afternoon and tomorrow when the tariffs begin. How do the Chinese react? Will they initiate their tariffs? How could they?
I think they're being forced into it. They're not going to make the first move, but if the U.S. administration goes ahead with these tariffs on a national level, I think Xi Jinping has to go ahead and retaliate as well. And you heard that in the Fed minutes as well. They're keeping their powder dry because they're saying business investment could dry up. This could hurt uncertainty in the future, and that's depressing the 10-year yield and why we're seeing this flattening curve.
Yeah, and you're getting a head nod from Diana.
Look at that.
It's like getting an A+ in English.
I was actually fairly surprised at how dovish the minutes were, that they went so far as to say that businesses have ratcheted back spending even in anticipation of the tariffs being implemented. So they're actually talking about the potential for growth to slow due to the tariffs. They spelled it out in the minutes. Again, that was a very dovish tilt in those minutes.
And again, now we're at the Dow's up 121 points. So we see it to be a little bit of a sell-off. Jack, it seems as if investors are looking at the Federal Reserve minutes for guidance, and the guidance they're getting is, ooh, this is not looking good with the tariffs.
Well, that's true. What we really need to see is the Fed tell us that fourth rate hike is off the table. I didn't get that out of the minutes, although I do think they're right.
Aren't they kind of saying that? They are saying that. The dovish tilt that we're talking about.
Well, we won't know until we get the next dot plot truly what they're saying. And the last dot plot
but
said
it's not a slam dunk.
Right.
I think that's what's. I think that the fourth rate hike is no longer completely baked into the cake.
Okay, but Jack, finish your thought. I'm curious because I am one of these people who follows your advice.
Yeah, no, let's, hey, I'm willing to wait until July 17th. I want to listen to Powell when he gives his testimony in front of the House and the Senate. He'll give us more clarity, I would expect, on whether that fourth rate, sort of rate hike is baked in or not.
Well, Suzanne, let me ask you this question. Susan.
You can call me that. I've been called worse.
You can call me Ray. You can call me Jay. Don't call me Johnson. You're not old enough to know the ad. When we talk about the yield curve, and I don't want to get wonky on all of this, but in simpleton terms, for someone like me, it seems as if we might be staring at a recession. We haven't seen this kind of flattening yield curve since right before the Great Recession, right, 2008.
We're at 2007 levels
That's
today.
right.
Yes,
Exactly.
and we hit those today.
Yeah.
We get the job number tomorrow. I would think, I made the case a minute ago, maybe you should be in equities. I would think right now is time to have some cash to the side or some short term, as Diane
It pays.
is saying.
No, I would agree with you. Yeah, some people are talking about taking cash off the table, and you're kind of seeing that. I mean, the rotation out of tech, people keeping their powder dry. I know that's a lovely Fed term as well, but investors like to, be prepared in case there is a full-blown trade war and people are shutting down investment and people are not buying goods because they're concerned.
Wait, what happens to this? You wanted to make a comment. You make your comment, then I'm going to ask you this.
Well, I think that investors should be aware of the fact that in prior cycles, we didn't have Twitter and social media. Right now, if you look at Google Trends, yield curve inversion is completely spiked. So there's so much more awareness than there was before. But for the last 3 cycles, when the Fed was tightening, they went on and tightened at least 3 or 4 more rate hikes after the point of inversion.
Yeah.
I think investors are getting ahead of themselves because inversion is not necessarily going to put the Fed on the sideline.
Maybe they got ahead of themselves. Go ahead.
But also recessions, when the yield curve inverts, sometimes it takes 6 months, sometimes it takes 2 years.
Yeah, the economists, they've predicted 7 of the last 15 recessions or something like that.
No, actually, the yield
Past
curve never
7
lies,
recessions.
but there is a lag time. The yield curve inverted in December 2005. We didn't technically go into recession until December 2007. That was 24 months after the point of inversion. People need to remember their market history.
And on that note, I want to smile, but I'm a little nervous now. I appreciate all of you being here, Jack, Danielle, and Susan.